Hey everyone, I'm Ed here with Down to Trade. So we've received a lot of different requests to discuss various topics in our videos, but this topic that I'm going to discuss today is by far the most requested, especially in the last couple weeks. Now, this is a strategy that we have fully implemented into the day trade room. It has been performing amazing, and we're really excited to see how far this very simple yet very effective strategy is going to take us this year. Now, that said, today I'm going to be teaching, kind of reteaching a very basic strategy that has really been killing it for us lately in the day trade room. And I say reteach because honestly, it's really one of the first strategies that new traders are going to learn as they kind of dive into the world of trading. But we've added obviously our own unique twist to it, and it has skyrocketed our results in the very short period of time. Now, there are very specific reasons why I chose this strategy for this current market, but we'll get into that later. Just understand that this particular strategy, when implemented correctly, like the way we designed it, can work in all market climates. We just kind of optimize the parameters for what we're seeing right now in 2024. So let's really just get into it. First things first, go ahead and take a moment, pause the video so you can read this entire disclaimer. But in summary, it really just says that there are obviously risks in trading, and past performance is not a guarantee of future results. The information contained in this video is not to be construed as financial, legal, or tax advice. And obviously, you assume all risks associated with any investment or trading strategy you choose to execute. So this is a breakout strategy. And as with many breakout strategies, it is rules-based and trend following. But what sets ours apart from other breakout strategies is that we seek to mitigate risk and maximize profits. Now, most breakout traders do not focus on risk mitigation, but I have made it the core of this strategy for many reasons, which we'll cover very shortly. But this is achieved by really cutting off our losers fast, quickly, and allowing our winners to run. Just to give you an idea, I'm filming this on, Thursday, April 18th, 2024. Now, in the last week, so in the last 5 days of trading, we have netted a positive rate of return of more than 5.5%. That's almost $4,500 in 1 week. And that's only with an account that has $60,000 in it. And remember, this strategy is scalable. In fact, here are all the trades we've taken since last Friday. So in the last 5 days, as you can see, our winning days are much larger than our one losing day on Tuesday right here. Now, you might also notice our win rate is lower than we typically trade with our old phalanx strategy. But that's completely normal and expected with this strategy. Remember, this is a breakout strategy. Like I said, the idea is to cut off my losers as quickly as possible and allow my winners to run. So naturally, when I'm cutting off the losers quickly, I'm going to have more of them. In fact, for the last week, when looking at my individual trades, my win rate is actually only about 67%. Now, that's a lot lower than our normal win rate for some of our older strategies, where the win rate was around 80 to 90%. But we've been able to turn those individual losers into winning days. Obviously, in the last week, we only lost on 1 day. But on that one losing day, we only lost 0.6%. But looking at my average winners, when I average out the winners for the last week, my average winning day was 1.51%. So when I did win, I was winning well over double what I lost. And this is why my expected return is so high. And just a quick side note, we developed this strategy years ago. We've been trading it for years, but a while back, I decided not to teach it in the day trade room as one of our main strategies because it can be a little bit frustrating for traders who are not used to cutting off losers so early. What I mean is most newer traders make the mistake of allowing their losers to run and cutting off their winners early. Now, my approach to this strategy requires the exact opposite, which does require a lot of discipline. And because we're a learning community, I try to avoid teaching this until I absolutely had to. In other words, I usually set this strategy aside as, in case of emergency, break glass. So when the market is getting really tough, I pull out this strategy and I trade it. And I use it as my emergency strategy because not only is it so robust, it just works. You don't need any fancy indicators or paid services, just a couple of moving averages and a lot of discipline. Also, the way we teach it is rules-based, so you don't really have to struggle with making any decisions or second-guessing your decisions. They're kind of already made for you. All you have to do is stay patient, stay disciplined. Also, So far this year in the day trade room, I've been trading a variation of this breakout strategy that we're going to talk about today alongside an iron butterfly strategy. Now, I was really trying to make that iron butterfly strategy work. I was just convinced I was going to be able to make it work, but every time I made money with this breakout strategy, I was just kind of giving it back with the money I lost on the iron fly strategy. So it's been frustrating to say the least. So I have decided to shelve that iron fly strategy for now and move forward with right now just the breakout strategy. Also, another quick change that I made so far this year, I'd been holding on to an old parameter from the phalanx strategy that doesn't really apply to the breakout strategy. Um, Namely, what I'm actually talking about is the fixed reward. As many of you know, I had been teaching to use a fixed risk and a fixed reward. So I would risk 3% to make 1%. And so for months now, I've been trading this breakout strategy and it has been working. However, I kept closing the day once I met that daily goal of 1%. And it was an old habit that should not have been applied to this strategy. That said, that has been changed. I no longer have a daily goal. I'm just allowing my winners to run. In fact, last Thursday was a great example of this. I had our bearish signal here and we jumped into a call credit spread. I took profit a little bit later and, right before a news event. And then a little while later, we jumped into a put credit spread. And it wasn't even 30 minutes later that I had to take profit because I had reached my 1% daily goal, my arbitrary 1% daily goal. So I was done trading for the day per the rule that I had at that point. When I sat back down on my computer later on in the day, I realized how much profit I left on the table. And it was that day, it was Thursday evening that I decided I'm no longer going to have a daily goal for this breakout strategy. So as of last Friday, I decided to take the cuffs off and let my winners run. I still cut my losers fast, but I'm letting my winners run. And it has been working again, fantastic ever since. So anyways, enough looking back. Let's get to the strategy. So continuing on, because this is a breakout strategy, I will attempt to take an always in approach, meaning once I enter a trade, I will always be in a trade until I'm done for the day. That doesn't include, news events and stuff like that, but the overall arching idea is I'm always going to be in a trade. This will be accomplished by entering, let's say, a bullish position when I have a bullish signal and remaining in that bullish position until I get a bearish signal, at which point I will exit the bullish position and enter a bearish position. In other words, switch over. And I will continue to switch positions, bullish, bearish, until I decide to be done for the day. Now, this strategy can be used on any ticker, on any time frame, and will work on both options and stocks. Now, I personally, in the day trade room, I use it on same day or 0DTE S&P index options or SPX. Now, this is a moving average crossover strategy. That's it. No oscillators, no RSI, no gamma exposure, Bollinger Bands, nothing like that. That said, I do still take support and resistance and, of course, news into account when trading and deciding when to exit. But other than that, the only indicator I'm really using is a moving average. So step one, obviously, is to choose a pair of moving averages and a time frame that you are comfortable with. Now, I personally use the exponential moving averages, specifically the 8 EMA and the 20 EMA. But truthfully, it doesn't really matter if you choose something similar. The key is to just be consistent in your trade over time. Now, because I day trade this strategy, I personally look for signals on the 2-minute S&P E-mini futures chart. Now, I chose the futures chart for my signals because they trade 23 hours a day, but you really don't have to. So I personally am looking for my signals on the futures chart, but trading the actual index. But again, this really can be used on any instrument you choose. You might wonder now, why use the 2-minute chart? Well, that's a good question. As you're all aware, the smaller the time frame, the more signals you're going to get. In other words, you'll see the EMAs cross more often on a 1-minute chart when compared to, let's say, the 3-minute chart. Well, that can be good and bad. On the 1-minute chart, you'll enter earlier and exit earlier, which is great, right? Meaning you'll take on smaller losses, but you'll have a lot more of them. Now, as we say in the day trade room, to quote economist Thomas Sowell, there are no solutions, only trade-offs. So if I went with the 3-minute chart, I'll have larger losses, but fewer of them. With the 1 minute chart, I'd have smaller losses, but a lot more of them. So I found that the 2 minute chart was an optimal trade off for this question. Now, as far as entries go, for a bullish entry, I simply wait for the faster moving average to cross above the slower moving average. But I don't automatically just jump in once the cross happens. I wait for a confirmation before entering the trade. And here's what I mean. I wait for the candle that corresponds to the cross, or what I call the crossing candle. I wait for the crossing candle to close. Then I wait for a price to break above that closing candle before I enter bullish. Same goes for the bearish signal. I wait for the fast moving average to cross below the slower moving average, and then wait for the break below the crossing candle. Let's look at yesterday for a great example. Now, you can see that we had a bear signal here at 950 on the 2-minute futures chart where the 8 EMA crossed below the 20 EMA. Again, that's a bearish signal. But price didn't break below that crossing candle until here at 10 o'clock. And that's actually where we entered the trade, right here at 10 o'clock, after we got the confirmation we were looking for. Now, we rode that bear call spread down to here, where we actually rolled it to another bear call spread where we actually were able to collect more credit. In that second bear call spread, we rode that even further until we exited here where I thought the bottom of the move was going to be. Obviously, I was wrong, but I did exit my bear call spread here. A little while later, I waited for price to break down a little bit more, and so I did enter another bear call spread here, and I exited down here again where I thought we had reached the end of our move. Now, we ended up closing the day out with 1.85% return on the day. The point is to wait for these confirmations, or you could get faked out by a cross. Be patient, be disciplined, and wait for your right entry. Now, for our entry parameters, you can really use whatever directional positions you're comfortable with. Now, I'm very comfortable with credit spreads, so I use them to my advantage. Now, you can use debit spreads, for instance, but they have a completely different gamma and profit profile than credit spreads. For instance, with a debit spread, move against you will cost you more than it would have with a credit spread. So you want to make sure that you understand how your position works and make sure that you manage it appropriately. But for a bullish entry, I personally use a 30 wide put credit spread, typically with the short leg near the 7 to 9 delta. And for my bearish trades, I use a call credit spread, again, with the 7 to 9 delta for my short leg, and my long leg about 30 points higher. Now, I am typically looking for spreads with a net credit between 55 cents and $1. For those of you who are familiar with our old phalanx strategy, you'll probably notice that some of these parameters seem very similar, but there are quite a few differences. For instance, like we mentioned earlier, I do not have a defined risk or a defined reward with this strategy, but instead, I use my signals to determine my entries and my exit. In fact, trade management is different, so we're gonna be touching on that very shortly. But first, I wanted to cover this real quick. Let's look at the profit profile of the two bullish spreads, the put credit spread and the call debit spread. Most of you already understand this, but I just want to make sure to cover it really quick. Again, these are both bullish positions. And all else being equal, they both make a profit when price action moves up. Obviously, I'm not taking into account theta decay or changes in implied volatility. I just want to discuss where each of these positions make the bulk of their profit. And as you can see, the purple line is the profit profile for the put credit spread, while the orange line is the profit profile for the call debit spread. Now, these curves are not drawn to any scale, but they should give you an idea how each spread makes money as price moves. Notice that the credit spread makes the bulk of its profit toward the beginning of the rally. And this is due to the decrease in gamma as price moves away from the legs of the spread. But eventually, the car kind of runs out of gas, and although the credit spread is still making money, it certainly does so at a slower rate. Now, contrast that with the call debit spread, which makes the bulk of its profit toward the end of the move as gamma increases as price is moving toward the legs of that spread. Now, obviously, the exact opposite is true for a move against your spreads. A debit spread will lose more at the beginning of the move against you, while the credit spread will lose more later in the move against you. We've all seen it with debit spreads, right? We're making a killing in our position, and then boom, the slightest pullback in price takes out a huge portion of profit. Well, that all occurs due to gamma differentials, and having a thorough understanding of them can only benefit you in your options trading. And look, at Down to Trade, we use these profit profiles in every setup we develop and trade. So I highly encourage you to do the same. Again, I realize this visual aid is mediocre at best, but it should point you in the right direction. Now, the position is going to go only in a couple ways. It's either going to run in my direction, in which case I will eventually take profit or roll for more credit, or it'll run against my direction, in which case I'm just going to switch directions. So let's break this down a little bit. Let's talk about rolling my position. Because I'm using credit spreads, gamma is going to decrease the further I get from my short strike. In other words, the farther price moves in my favor, the slower my profits will increase. Remember, my profit is still increasing. It's just not increasing as fast as it was at the beginning of the run. Therefore, in order to maximize my profit on a price run, I'm going to roll my spread closer for a credit. I will typically look to roll once my premium has decayed approximately 50 to 60% of my net credit. And I will continue to roll the spreads closer. By closer, obviously, roll them up for a put credit spread and roll them down for a call credit spread. But I'm going to roll them closer until I'm either done trading for the day or I get an opposing signal, in which case I'll just switch. If price consolidates sideways or moves against me, I will likely get an opposing signal as price failed to break out. Remember, we're hoping that price is going to break out, but if it fails to break out, I'm likely going to end up just getting an opposing signal. Now, once I get the opposing signal, remembering to wait for that confirmation, I will buy to close the existing spread. So I'm going to close the existing spread and sell to open the opposing spread. Now, quick side note, when it comes to Think or Swim, after I enter a position, I typically build my switch order immediately. So as I enter the position, as I enter any trade, I build my switch order immediately using the first triggers all advanced order type. Now, the first order will be my closing market order to close the existing position, right? The second order will be the open market order to open the opposing spread. Now, we cover this in detail at Down to Trade. So if you have any questions, certainly reach out. But the idea is to make the switch the moment you get the confirmation of the opposing signal. That's why I use a market order personally. Now, once I get the opposing signal along with the confirmation, I will send the custom order. Now, once that first order is filled, the second order will begin to work and should be filled rather quickly because, again, it's a market order. Now, again, if you're not tracking, don't worry. It's not that big of a deal. It actually isn't that complicated. You can easily learn it. It would just be too much for me to cover all of that here in this video. But I would highly encourage you to check out our free trial at Down to Trade. Not only will you get to enjoy our trade rooms for free, but you'll also get to download your own copies of our guidebooks for this and all of our other strategies with all of the parameters that we personally use in our strategies. So now here's an example from Monday. Now, as you can see, I entered the 51.95 by 52.25 call credit spread after receiving a bearish cross. Now, I actually couldn't get filled on the entry as quickly as I wanted, and I ended up getting in a little bit late, as you can see. I was trying to get in on this candle right here after confirmation, but I wasn't so fortunate. But we made it work, and we were able to get into the trade. Now, I got that credit spread for 75 cents, and when it got down to about 30 cents, I rolled it to the 51.80 by 52.10 call credit spread for 50 cents more credit, meaning I bought to close the original credit for 30 cents and sold to open the new one for 80 cents, giving me, again, the net credit of 50 cents for the entire roll. Now, price did not continue in my direction, and a little bit later, I switched on a bullish signal that occurred here. I bought to close the call credit spread for break even and sold to open the 50.85 by 50.55 put credit spread for 75 cents. Now, price ended up reversing, and I waited until I received a bear signal with confirmation and again switched back to another call credit spread. I was in this last call credit spread for about 30 minutes when I decided I was done for the day. Now, with my 2 wins, my 1 loss, and my 1 break-even trade, I ended Monday with a 1.13% return. That's not bad for having to manage my trades twice. But notice, I'm staying disciplined and cutting my losers off quick, without hesitation and without remorse. Now, I know some of you are probably saying to yourself, Breakout strategies are just too simplistic. And honestly, you'd be correct. This strategy cannot be more simple. But that's kind of the point. And here's what I've learned. After several years of coaching and mentoring traders, I've learned that there will always be a new shiny wazoo indicator out there or a tool out there that you can buy. And sure, some of them might be really insightful and a few of them might actually help you in your trades. But the one thing I can certainly tell you is this: that really cool tool will only be effective for so long. And that isn't because there's something wrong or there's some flaw with the tool itself. It's just rather due to the major shifts in the market climate. Market itself is always evolving, always. Every single day, the market is evolving and transitioning into something new. And so that really cool tool that worked for the last 4 or 5 months might not work next month. Now, I've been a full-time trader for several years, and I can honestly stand here or actually sit here. I can sit here and tell you that I have never once purchased a wazoo indicator or a fancy new trade service that provides a shiny new data chart from the market. I have seen a lot of them, and I've even tested several of them. But in the end, I've actually never purchased any other than paying for like news, like a news feed like Financial Juice, which I personally would never trade without. But in the end, give me my news, my price action, my volume, and my strength, and I'm going to find a way to make money. Now, I say that because these are the real skill sets that separate winners from those who perpetually struggle in the market. Now, we've all seen these types of traders. They never take the time to actually develop their basic trading skills, but they instead purchase a fancy tool that claims to provide some kind of edge. And when they no longer find success with that tool, they move on to purchase another one and then another one and so on. Now, I am not saying that you should stay completely away from these services. Not at all. What I mean is I would prefer that you take the time to really learn to trade the basic skills of the market. I quite literally mean those skills you were taught when you first learned to trade. Why? Because those skill sets never die. I often get the feeling that when I coach a trader on these very basic strategies, they somehow feel like they're less of a trader if they don't have 20 windows on their screen with data screaming at them all day long. Like it's almost like they have convinced themselves that they're not a professional trader if they're not looking at 6 monitors full of graphs and data all day long. But honestly, you don't need all of that noise. In fact, it can be counterproductive when you're first starting out, even for the first 5 years or so of trading. Now, again, I am not sitting here trying to tell you that you should never get some of these services. I would just rather that you take the time to develop your foundational skills first. And this strategy is exactly one of those. It does not get any more simple than this breakout strategy. Now, again, we've obviously optimized the parameters of our breakout. Now, I would certainly encourage you to back trade this strategy for 20 minutes, 5 days a week for an entire month. Now, if you'd like to see us trade it live, you can certainly join our 1-week free trial and you can see us trade it live. You can interact with us as we discuss each position, and that'll give you a chance to learn all of the specific parameters that we use and see what's going through our head as we enter and exit our positions. So head on over to downtotrade.com and check out our free trial. I'll leave a link in the description below. Again, head to downtotrade.com. You really have nothing to lose. We're a great learning community that thrives off of each other. You're not going to find a more friendly, encouraging group of traders anywhere. Now, if you got anything from this video, do me a favor, hit that like button and don't forget to subscribe. Do us a big favor also, leave us your questions and comments down below. That's going to be it for me, everybody. Again, this is Ahmet from Down to Trade reminding you to learn it, trade it, and profit. Take care, everybody. Happy trading.